We propose that Bharti Airtel should be given BA1 rating with negative outlook, and the rationale for the rating could be summarized in terms of medium grade business risk, low credit strength, and distressed solvency.
Greetings to all. We are team number 166 and we are going to present a credit report on Bharti Airtel. Bharti Airtel is the third largest telecom service provider in terms of number of subscribers. In India, it is a reputed telecom service operator providing mobile, broadband and DTH services. India operations had 348 million subscribers as on 30th September 2018. It has a presence of 445 million subscribers at global level including India, South Asia and Africa. The business portfolio includes 6 units, that is, wireless services, home services, digital TV services, Airtel Business, tower infrastructure and others. It has more than half of its revenue coming from domestic mobile telephone services, while the enterprise services contributes to around 14% and the tower infrastructure contributes to around 4%. Now, let us analyze the telecom industry further from a holistic point of view.
Moving on to the telecom industry life cycle. Currently, it is in the shakeout stage of the industry life cycle, and new players such as Jio is adopting predatory pricing to increase demand and thereby putting downward pressure on the bottom line. Thus, weak players are either exiting from the market or are consolidating with the strong players. Leveraging this opportunity, Bharti Airtel has entered into deals with other telecom operators to increase its revenue market share and spectrum footprint. Primarily, the market is transforming from perfect competition to oligopoly with 3 major players, Airtel, Vodafone Idea and Reliance Jio, having approximately 80% of the wireless revenue market share in FY18, which is expected to grow to 93 to 94% by end of 2019. Now let us have an exhaustive analysis of Airtel's corporate governance practices. The corporate governance structure is multi-tiered. At apex level is board of directors and various committees chaired by Mr. Sunil Bharti Mittal, who is responsible for overall strategy development. At one level below the board, strategic coordination and direction is provided by Airtel Corporate Council ACC, headed by chairman and comprises managing director and CEOs. Of the total 6 business units, mobile services business is headed by Mr. Gopal Vittal, who is the MD and CEO of Indian and South Asian operations. The rest 5 units are headed by respective MDs and the CEOs. This multi-tier structure allows Airtel to retain the organizational DNA and at the same time enabling effective delegation of authority and empowerment at all levels. Moving on to the composition of the board, there are 11 board members including 2 women directors and all of them are from the diverse background. About 55% of the board are independent directors. Further, if we look into the shareholding pattern, 50% is held by Indian promoters and 17% is held by foreign promoters such as Singapore Telecommunications, Pastel Limited, having significant influence over the company. There has been a proven track record of timely disclosure of information in terms of operating and financial reports. In fact, CRISIL has assigned CRISIL GVC rating 1 for its highest corporate governance practices. So here we can conclude that Airtel has high corporate governance practices. Moody's scorecard was adapted and the assessment is done by the team based on various qualitative and quantitative parameters to score and arrive at the final credit rating of Airtel. Supporting calculations are provided in the Excel sheet. The 5 rating factors are based on number 1, scale of operations, business profile, sustainable profitability and efficiency, leverage and coverage ratios, and the financial policy adopted by Airtel. Now we will analyze each sub-factors to identify the key rating drivers impacting the credit rating of Bharti Airtel. So starting with scale of operations. Given Airtel's scale of operations and strong market position, it is able to withstand temporary disruption and competitive pressure in the consolidating telecom industry. Also, it is able to provide bundled products such as using DTH services to cross-sell postpaid connections and as part of Mera Pehla Smartphone program, strategic alliance with handset OEMs. It is geographically diversified company having a common management team with strong business and financial links between Bharti Airtel India, South Asia and Africa and Bharti Infratel, giving it access to financial markets and availability of unused credit lines. Moving on to the next factor is business profile. The key metrics considered for assessing Airtel's business profile includes geographical diversification, revenue mix, market share, competitive and regulatory environment, and technological positioning. Since 2017, profitability of African operations is ensuring Airtel's profitability at the consolidated level. Because of conducive environment and operational efficiency, EBITDA margin of African operations has increased to 37% in the quarter ended September 2018 as compared to 33% during the same period last year. It has recently raised rupees 9,200 crore through private placement in African operations, most of which would be used for debt reductions. Upcoming IPO listing of African unit sometime in June-July is a significant ammunition to fight price war in India and to deleverage its balance sheet. As the core mobile services have been commoditized, revenue contribution from non-mobile services accounting for approximately 23% of the total revenue is supporting the mobility businesses. Digital TV and Airtel business has EBITDA margin of 39% and 41% respectively. Performance in these businesses is expected to remain steady, supporting the pricing pressure in Indian mobility business. Now, moving to the competitive environment. The closest competitor for Airtel wireless services in Indian market are Vodafone Idea and Jio, and global competitors are AT&T and Vodafone Group PLC. Post Vodafone Idea merger, Bharti Airtel is no more a market leader. Now it has second highest market share of 31% and wireless subscriber market share of 29%. To arrest the declining trend of ARPO, Airtel has introduced minimum recharge plan, which has led to increase in churn rate of about 7.3% in Q3 FY19. Thus, an upward revision of ARPU is expected in the following quarters. Moving on to the technological positioning, CapEx as a percentage of revenue is used as quantitative assessment for technical positioning. As it can be seen that CapEx is 36% of revenue, indicating lower risk of technology obsolescence. Next is the regulatory environment. The telecom industry remains susceptible to regulatory changes. We now consider few positive and negative aspects of the regulatory environment. The few positive drivers are a fully developed regulatory framework, extension of spectrum repayment period from 10 years to 16 years, and agenda of National Digital Communication Policy in 2018 for rationalizing spectrum usage charges. Negative drivers would include reduction of IUC charges from 14% to 6%, favoring the entrant Jio, disallowing operators from spending or sending special offers to select customers due to restriction on discrimination pricing, regulation of international roaming charges by TRAI, and non-predatory pricing policy for the incumbents.
Moving on to profitability and efficiency. One of the key rating matrices in assessing the risk to debt holders is the level and stability of operating margins. The scoring of this sub-factor is based on forward-looking qualitative assessment of sustainability and revenue growth and ability of the company to maintain margins on a sustained basis. We can see a sustainable decline in the net profit margin, which is 3% in financial year 2018 and is likely to plummet further in financial year 2019. Irrational competitive environment is putting pressure on the pricing ability of the company, and this scenario is likely to continue further for another 12 to 18 months until Jio becomes a significant market player. We have identified few positive and negative key rating drivers for profitability and efficiency ratios. The positive drivers are introduction of minimum recharge plan, monetization of bundled services such as postpaid bundled plans along with Amazon Prime and Netflix, diversification to non-mobile businesses and digital services, launch of enterprise-wide cost reduction program known as War on Waste, aiming at increasing operational efficiency. The negative drivers are irrational competition, over-dependence on the Indian operation, which is contributing about 77% of the total revenue, and high spectrum prices across bands equivalent to 1/3 of the adjusted gross revenue. Coming on to the leverage and coverage ratio, we have done quantitative assessment to understand the liquidity and solvency position of the company. First, let's talk about the capital structure of the company. Broadly speaking, the company holds assets in the term of cash and cash equivalent and bank deposits to the tune of INR 50,000 million. As per the recent figures, long-term debt accounts for 31.7% of the total capital structure and short-term debt accounts for 9.7% of the total capital structure, and the rest is market capitalization of the stock value. The gearing ratio comes out to be 60.1%, which has improved marginally over the previous years. Total debt to EBITDA ratio is increasing over the past past few years. Higher investment for 4G network rollout and enhancement is leading to increase in capital expenditure. We can see there has been an increase of 34.9% in the capital expenditure over the previous year. And the continued pricing pressure is adding on to it. And these are responsible for the higher debt to EBITDA ratio. Decrease in retained cash flow to debt is due to 23% increase in the total current liabilities, which includes current portion of long-term debt, which has increased by 185% as compared to the previous year. And also the short-term debt liability has increased by 45.9% from the previous financial year. Declining trend of retained cash flow along with increasing capex suggests limited cash availability for reinvestment in growth opportunities and technology upgradation. Forecasted growth rate for Airtel is 3.5% to 4.5%, whereas the sustainable growth rate comes to be 0.15%. This suggests Airtel will either have to infuse equity capital investment or will have to increase the financial leverage by going for debt financing. As we can see, operating cash flow has high reliance on Indian operations, which is subjected to aggressive pricing pressure, thereby substantially impacting the coverage ratios of the company. EBITDA is increasing at a rate of 1.77%, but interest expense is increasing at a CAGR of 12.2%, thereby weakening the ability of the company to pay short-term debt borrowings and trade payables. To create a natural hedge, the company has spread debt across local and overseas sources of fund. The company has also entered into interest rate swaps to reduce interest rate fluctuation risk. Now, we will talk about the key positive drivers for the coverage and leverage ratios. Deleveraging initiatives taken by the company such as equity dilution of the African operations, stake sale of non-core businesses such as Bharti Infratel Limited and deconsolidation of the payment banks. Relief package provided by the government extending the spectrum liability payment from 10 years to 16 years is another positive driver. The negative rating drivers would be increasing capital expenditure towards network enhancement, possibility of 5G spectrum auction in 2019, future liability towards spectrum license fee and mobile tower rentals of acquired units such as Tata Teleservices and Telenor India, uncertain profitability of the core Indian mobile segment. Now coming on to the financial policies. The scoring of this factor is based on qualitative assessment of financial policies adopted by the firm. The positive rating drivers are prudent liquidity management by setting up of strategic investment group, monetizing strategic investments such as secondary IPO of African operations and sale of stake in subsidiary Bharti Infratel Limited. The negative drivers are refinancing of debt and spectrum liability by issue of rupees 30,000 million for unsecured non-convertible debentures. Also, the execution risk of the deals, that is, deleveraging through asset sale, is subjected to market timing and may get delayed due to regulatory requirements and shareholder approvals. As we can see, Allman Z-score for Bharti Airtel is in distress zone, suggesting low credit strength. Before summing up, following are the key risks impacting the credit rating. Further undercutting of ARPU, regulatory challenges in mergers and acquisitions, realized synergies of Vodafone Idea Limited, delay in execution of deleveraging plans, larger than expected capital expenditures, debt-funded 5G spectrum acquisitions, and economic uncertainty such as inflation, interest rates, and currency fluctuations.
So, summing up, we as credit analysts would like to suggest an overall rating of BA1 for Bharti Airtel with a negative outlook on the basis of Airtel's highly leveraged balance sheet along with uncertain cash flows and profitability straining the debt coverage matrix. This could be attributed to the prevailing competitive dynamics in the telecom industry.